All right, well, we have a lot to get to, y'all. We had a lot of news break this morning concerning the economy. We're going to dive right in and talk about how it's impacting interest rates, what it might mean for housing, and just kind of get our arms around the breadth of the news that hit this morning, because it's a lot. Let me get to the punchline first and foremost. Here's the spoiler. Interest rates are unchanged, y'all. They are unchanged really going back a week or so. We were at 6.04 according to Mortgage News Daily a week ago. That's exactly where we are today. If you look at the day over day, we were 6.05 yesterday. So we're just a hair lower today than we were yesterday. But if you look at a bond chart, y'all, it's been pretty flat for the last 5 days or so. You go back to 30 days ago, according to Mortgage News Daily, the national average was 6.21%. So we are quite a bit lower if you look at a 30-day time frame. So the good news is the economic data we got this morning did not blow up the bond market like many were concerned might happen, but it also didn't give us massive improvement had these reports come in more friendly. So let's get into the mixed bag that we got. Personal consumption expenditures. This is the Fed's favorite gauge of inflation. It was not good. It came in a tenth higher than expectations, both in the month over month. It came in at 0.4. Economists were expecting 0.3. And the year over year, if you look at the annualized number, economists were expecting 2.8, we got 3.0. So we got a hotter report than we expected, Joel, and that's not good news when you're trying to predict where the Fed might be headed. However, hot on the heels of that report, we got Q4 GDP, gross domestic product for the fourth quarter of last year, 1.4%, y'all. We were expecting twice that much growth at 2.8%. So that was a huge miss. We got half the economic creation that we were expecting in Q4. However, the majority of that miss is attributed to the lengthy shutdown that we had in Q4. So it's likely we're going to see pretty significant upward revisions when we get into the Q1 numbers. But it's that softness of that GDP number, y'all, is so much coming in so much lower than expectations. Because remember, the expectations were tempered somewhat with the knowledge that we had a shutdown. So we thought that was baked into that 2.8% number. It wasn't. Quite a bit weaker than expectations. That offset the damage done by the PCE number. That kept us flat. And then we got the big outlier this morning, y'all. We got the Supreme Court of the United States striking down the Trump tariffs that we have seen. And it's initially the market was very negative on that. I saw interest rates, bond market spike quite a bit higher in rate, quite a bit lower in cost on the news of that, out of concerns of what's going to happen to the $175 billion that's already been paid in tariffs. Are those going to have to be refunded now? Well, the Supreme Court didn't address that, y'all, so there's going to be more legislation needed, or more litigation, rather, to get to the answer of that question. But the bond market immediately assumes that that $175 billion is going to have to be refunded. That adds to the deficit. That means more debt issuance. More debt means lower prices. Lower prices mean higher yields. Those yields are our rates. So it's not good when we're increasing the deficit in a $175 billion unexpected way, y'all. So that is still hanging over the market to a degree. However, folks are becoming more and more comfortable with the notion that the administration still has a lot of ways to impose tariffs. So the revenue itself from tariffs is not likely gone. In fact, what the Supreme Court did do is provide some certainty around what can be considered a tariff that the executive branch can execute and what can't. So now that we have clarity around that, markets are going to congeal more around the tariffs that are still available to the executive branch. They can still impose tariffs for national security to make sure that critical supply lines are not interrupted. They can still unilaterally impose tariffs when they see unfair trade. Specifically, they can impose reciprocal tariffs on countries that tax us at a certain percent. We can do the same for them pretty much automatically, y'all. And then we also have the ability under another third section of the law where the president can impose tariffs when he has large trade deficits showing that we are being unfairly treated by other countries. Now, the reason the administration didn't use any of these three provisions of the law to impose the initial tariffs, they preferred instead to use the Emergency Economic Powers Act to do that. That is specifically what the Supreme Court struck down. They said that you have overused the Emergency Economic Powers Act to impose all of these tariffs, and that's what they have struck down as the rationale for the tariffs not just the tariffs themselves. The tariffs themselves can be reimposed under any of the other 3 sections of the law that I just listed. However, there's a test associated with each of those 3. There was not under the Emergency Economic Powers Act. So it was just simpler. The administration took the easier path without having to make a case for under the law for the other 3 provisions that are now going to have to build that case. Most folks looking at it are going to see that they can pretty easily do that because it's pretty much undisputed that we are unfairly treated in international trade, y'all. And rectifying that is something the executive branch has the right to do. Hindsight being 2020, it would have been better had they done this initially, and they wouldn't have been facing this potential shutdown from overusing the EEPA in the way that they did. In any event, a lot of uncertainty around what are we going to do to refund the people that were already charged. Keep in mind that many of those folks, the end user that bought the product paid a surcharge. So do you refund to the importer when they pass that fully on to the borrower, or do you find, or not the borrower, the end user, the end customer? So the Supreme Court left that unanswered, which makes for a very muddied and muddled decision from a litigation standpoint. And it's just going to, again, I think Trump in a post-decision press conference indicated this is all going to have to be litigated. I mean, we don't even, how do you even identify who's owed the money at this point? So that's going to be a challenge. All right. That's a lot to digest, y'all. The good news is all of this basically, the bad news essentially offset the good news that we may have received this morning. That said, interest rates are flat and better than they were, almost a quarter of a point better than they were 5-6 weeks ago, y'all. Let's take those benefits. Let's keep looking towards the future. Take whatever nice reprieves we get with regard to interest rate, put it in the bank, get those rates locked. Don't let these float. A lot of volatility right now, y'all, with all of this uncertainty around the stuff we're discussing. So in any event, I know this was a lengthy video this morning. I hope it was helpful for you and for your clients. Please feel free to share this. And as always, we do this because we appreciate your referrals, y'all. And we want to make sure we've got the most educated client base out there with regard to what the market's doing. So always blessed and honored to have your referrals. My contact info is on the screen, and I will keep an eye on it as always. We will talk to you next week. Stay blessed, stay safe.